Okay, so how company raise money by selling a common stock? So company have mainly three different options, three different way or three different option, or maybe company choose all these three ways to raise money. So the first one is selling shares to venture capitalist, right? Venture capitalist. Who are the venture capitalists? Venture capitalists are the people, they are more likely to invest money in risky projects, high projects, I mean, the big projects. So these are the people who invest. So these are the people, or shareholders, venture capitalists, right? Raising capital by selling stocks to these people. So venture capitalists are the shareholders or the people who invest into high risky projects, big projects or highly risky projects, right? So what these kind of projects are, so I'm going to give you a few examples of these kinds of projects which are known as high risky projects, right? Under this type of projects involve such as mines, like as coal mines. So mining business is a risky projects. Right? Then business about aircrafts or airplanes, right? Or airlines, right? Airplanes, right? Petrochemical, right? Or maybe extreme machines business, like the machines that maybe used in some kinds of big project. That machines could be I don't know, it's like a big truck, huge trucks, right? So that's maybe used for the construction purpose, or any other kinds of machines that involve in a construction. We also call them extreme machines. Right. So these kinds of projects known as venture projects. The meaning of venture is a risky, high risk projects. So the people who invest money in these kind of projects, we call them venture capitalists. So if the business is a risky business, company more likely to find a venture capitalist people, right? Venture capitalist. So this is the first type of the first way to selling stocks among venture capitalists. So these kind of businesses. Second one is angel investors. All right, angel investors. So why we call them angels? Why we call them angels? So the reason to call them angel is that if any kinds of business, the new business, which is looking for the investors, so these kinds of people more likely to invest money in a big, I mean, not the big, the new businesses, right? So if you are looking for financer, so probably you can contact these kind of people. So what is the good thing about these kind of people? They invest they invest in new businesses. So the people invest in new businesses, in a new business. All right. But the interesting part that is why we call them angels. Why don't we just simply call them investors? So the reason to call them angel is that these people, they invest in a new business without controlling operating activities. All right. Without controlling operating activities. But normally, the practice is that whenever shareholders, they're going to invest money, or the people are going to invest money in a business, from the shareholders' point of view, they're more likely to control over company operating and financial activities. But these kinds of people, they simply invest money, but they do not take any kinds of decisions over the. I mean, they don't control any kinds of things which is related to the company operating activity, unless company asks. That's different scenarios, different story. But initially, they don't have such kinds of power, or they do not kinds of involve in such operating activities. Maybe so it's completely under the company hands. Whatever decision company wanna take towards their projects. New projects or new product. But of course, you have to convince these kinds of investors that whatever decision we're gonna make it for this product is really good. But of course, at initial levels, they don't have any kinds of decision whether yes or no. Right? So that's why we call them angel investors, or maybe new business or new startups. We can use these kinds of we can find these kind of people if you have a startups, because we have ideas, but of course we are lack of funds, so we have to find financiers who can finance our ideas. So you can contact them, right? So this company can also raise finance through angel investors, right? And the third one, which is quite common, is number 3, is a going public. Going public. So third way to raise is going public. So under going public, we have 2 kinds of way to raise money. One is 2 ways. So first is a private placement. Private placement. And B is public offering. Anybody remember private placement? Because this private placement, we already covered in topic 2. Anybody remember what does it mean? Private placement? Anybody, any idea? What does it mean, private placement? Tell me, what is private placement? Topic 2, when we study topic 2 about financial markets, then under financial markets, we learn this capital markets and everything. Then we also looked at the private placement. Anybody, tell me, what is private placement? What is private placement? Quickly, tell me, what is private placement? Can you hear me? Yes or no? Say something. Can you hear me? Students, do you hear me? Sale of stocks, bond security directly to the private investors rather than as part of public offering. Yes, that's right. It's a direct selling to the specific people that company wants to become a common shareholders. Right? So this is called the private placement. And student, remember one thing that I mentioned in the last lecture as well. Whenever I ask you anything, I have information, I have a name of the student who are answering my questions. All right, because we're not gonna have a maybe class activity or performance test. So I'm looking that who gonna give me answers and who is not giving me answer. So I'm saving all the information. So when I'm gonna assess for your midterm, I will lose the points. I will give less points to those students who do not participate in my discussion, who do not answers my question or simply ignore or keep silent. You have to react, all right? You have to respond to my questions. If just only one student like as Huang Tong, this student is always answer my questions. So how about the other students? If you do not answer my questions, definitely you will lose your marks. So please be involved, be active, all right? Not just simply open a screen and then you keep doing something else on your mobile phones. No, you have to pay attention. You have to be engaged in all kinds of activity that we are doing through this online teaching. So remember that, all right? Otherwise, don't complain that why you got low marks, all right? So now private placement. So under private placement, company direct select people company directly sell stocks to the specific people, right? And these specific people, they're gonna be controller of the company. So they're gonna be a controller of company. They're gonna control the company. We also call them majority of shareholders. So majorities. All right. So company choose who gonna be majority of shareholders. They're gonna be involved in any kinds of operating and financial decisions. All right. Operating and financial decisions. So decision making. So these kinds of people. So that's called the private placement. So company choosing them. And second option is company goes into public. All right. So let's talk about this one. Company goes into public in the next slide. Three B. Right. So this is 3B. 3B is a public offering. All right. Public offering. So under public offering, company has two ways. So public offering means when companies sell its share among general public. Selling among people. In simple words, company is inviting everybody. So everybody can come and buy the shares. Like as for example, you and me. we can be part of this kind of public offering. Whatever company is selling stocks or IPOs or anything, company is willing to sell, company can offer these kinds of stocks under public, not just a specific people, anybody, you and me, we can buy and sell, right? So how can companies sell these kinds of stocks? So company has two options, two ways, right? So company has two ways. That's kind of public offering. One is through OTC, right? And through stock exchange. What is OTC? Anybody? Any idea? What OTC stands for? Over the counter. And what does it mean? What is the difference between over the counter and stock exchange? Anybody? Any idea? Tell me, what is the difference between over the counter and stock exchange? Anybody quickly tell me, over the counter, what does it mean? What is over the counter? OTC is a new stocks? No, OTC is not a new stocks. That's primary markets. OTC is not for the new stocks. Primary markets for IPOs, initial public offering. Over the counter refer to the process how securities are traded for the companies not listed on the formal exchange. Did you copy the meaning of over from the internet? Make sure you do not simply copy paste from internet. Whatever information that I provided you in the previous sessions, you use that information to answer my questions. All right, because you simply copy and paste from internet, you're not going to learning anything. All right, please don't do that. Student, make sure try not to use the short name. You use your full name on your Zoom, all right, Zoom accounts. If you are writing your short name, I cannot find your name, and then you will get absent. All right. OTC not listed from stock exchange. Yes, that's right. So remember, what is OTC stand for? Of course, OTC stands for over the counter, and OTC markets are those markets in which we buy and sell only those stocks which are not listed on stock exchange. So stocks which all right. So the stocks which are not listed on stock exchange, we trade in OTC. This is for unlisted. And stock exchange, of course, for listed, right? For listed. So another name of stock exchange is the capital markets. Capital markets, what's they call it? Stock exchange. So under capital markets, we have a primary markets and we have a secondary markets. And you know that primary markets for IPOs and secondary markets for stocks. So this is the way to sell share among people using two different markets, OTC and stock exchange. So, but the good thing is about stock exchange is that, as you know, that we can get the price of the stocks online. However, under OTC markets, we have to contact this market through phones to find the price of the stocks, and then we have to request this OTC markets to buy on behalf of you, right? So buy for you. So this is the difference between this OTC markets and a stock exchange, right? So these are the things about common stocks, all right? Now, next. And the next things now we're going to cover is, so you know that if company wanna sell its common stocks, so company need a license. Right. One thing we forgot to mention here is underwriters, as I forgot to explain you. Anybody knows what is the meaning of underwriter? What does it mean, underwriters? Anybody tell me what does it mean, underwriters? Yes, underwriting services are provided by large financial, but what does it mean, underwriting or underwriters? Um, the person or institution that agree to sell a minimum number of securities of companies for commission is called underwriters commissions. Okay, and provided by large financial institutions. Underwriters are part of that evaluates and assume another party to risk. Again, please do not copy and paste from internet. Um, okay, yes, that's right. Underwrite, underwriters are basically the financial institutions that help companies to sell its share among the people, right? Of course, because these kind of, let's say, take example of the banks. The bank has many customers, all right? So banks could be involved in underwriting services, which means bank is uh, helping the new companies who is willing to invest money in willing to sell its shares in a market. So, and bank has a multiple customers. So banks can convince their customer to buy the stocks of that company. But again, before agree to selling the stocks, banks, they're going to study the business plan of that company's project, license and everything, and approval to sell the shares and everything. If everything is fine, then bank will buy shares from companies, and in exchange bank will supply them money. And once bank bought a shares, of course bank not going to be a part of shareholders. Bank will sell those shares among the people going public. It's exactly same thing. It's exactly same thing that I explained you in the video, the cartoon video that I mentioned last time in the class. So this is the for um, ideas for underwriters, and of course for providing such kinds of services, that financial institution being an underwriter is going to charge some commissions from banks or that financial institution. I mean, commission from their companies. So that commission called underwriting commissions. Right? So this is the thing that we happen when we're going to sell our shares in the markets. Right? So underwriters, they play a very important role in a capital market. So now, next is a license, right? In order to get license before selling these common stocks among people, company needs a registration. Company need a registration. In simple word, registration also indicates the license. Once you registered, which means you got a license to sell shares among a company. If your company is not registered, license means your company is registered to government, all right? If your company is not registered to government, you are not allowed to sell common stocks among people. If you try to sell common stocks among people without any license or registration, so which means you involve in such kinds of clink or such kinds of fraudulent activities, such kinds of illegal activities. Right? So this is the minimum requirements for the companies, but this condition apply to the companies, not for sole trader or partnerships. Maybe they have different provisions for the business license, but they don't have specific provisions for selling of stocks. Right? So because sole trader and partnership less likely to involve in selling stocks, companies is involved in selling stocks. So that's why they need a registration. So once you got registered, then you will sell shares among people. But now the question is, how do you sell? How sell? How, instead of saying how sell, how company inform? How company inform to the users, how company inform in a markets that we are willing to sell our stocks, and this is the information of stocks. So how company inform? Company inform through prospectus. Prospectus. What does it mean, prospectus? Company issue prospectus. Now, what is prospectus? Prospectus is a booklet. It's a booklet, or it's a brochure that's providing all kinds of information about that companies to the people, and those people, they can read. It's exactly the same like as pamphlets. So many companies, let's say, take example of Ho Chi Minh City. Have you ever seen that when you are, sometimes you stop on the red lights, people are selling you pamphlets? So these kind of marketing about that particular product, maybe pamphlets about apartments, house, land, buildings. All right. So people read their pamphlets and they make a decision. So this pamphlet is just an example. Company do the same thing, but of course, company do not use just a single paper, which is pamphlets, because company has too much information about its plan, its project, its product, its shares and types of shares and everything, and license and all the information about the companies. So potential investors, they can read that information, and after reading information, they can make a decisions whether they want to buy or not. So this is called prospectus. So this is important to issue prospectus among people if you want them to buy your shares. Why? Because through the prospectus, they can get complete information. Prospectus is a booklet, but we don't call it booklets. I'm writing booklets for you to understand the meaning of prospectus. It's like it's booklets, small book, right? So the purpose of this prospectus is to provide detailed informations to users. So these users can make a right decision. Decision over buy or not to buy stocks, right? So because we need a complete information before we're making a decision. If information is incomplete, so we're not gonna decide whether we should invest or not invest. That's why company is writing all the information in that prospectus, and then company distribute that prospectus among people. They read it. That people could be private placement, the people could be going public, the people could be venture capitalists, or people could be business angel investors, anybody, right? So this is the ideas for selling common stocks among people, right? So issuing common stocks is finished. So let's move on to number 3. Before we move on to number 3, anybody has any question? Any question? Yes or no? No question. So let's move on to next. So now the last learning outcome for this topic is a common stock valuation. Common stocks valuation. Under this common stock valuation, we're gonna learn that how we estimate the value of common stocks. I repeat, under this common stock valuation, we're gonna learn how do we find the value. Value means present value of the stocks, value right now. Estimate the present value of stock. So if we know the present value, so this is the common stock valuation methods. So we have various methods to find the present value of stock. So we have four methods, right? The first method is the basic method, that you know that. So the basic method is we gonna discount the future value, right? We discount the future value to estimate the present value of stocks, right? So we have four methods. I'm gonna write these four methods. So the first method is a basic stock valuation method. Basic stock valuation method. Second method is a constant growth method. Third one is a non-constant growth method. And the fourth method is a zero growth method. So we have these four kinds of methods: basic stock valuation method, constant growth method, non-constant growth method, and zero growth method. Under basic stock valuation method, it's a basic method to estimate the present value. And you know that how we estimate the present value. We estimate present value by discounting the future value, right? So we will discount the cash flows. Discount the cash flow. If you discount the cash flow, we will reach to the present value. So the formula is cash flow divided by 1 plus R and time. Right? Now, but one thing we need to understand, what does it mean cash flow here? Cash flows means cash inflow. Cash inflow means future dividend. So in simple words, if you discount future dividend, I repeat, if you discount future dividend, you will reach to the present value of the stocks. Right? That's the meaning of basic stock valuation method. Second method is the constant growth method. Under constant growth method, we estimate the growth of the method. After estimating the growth of the method, we discount it, right? We will estimate the growth. Once we got the growth of the stocks, of course, which is the dividend, because dividend represents the growth of the stocks. Once we estimated the growth, then we will discount it. But of course, method 2, 3, and 4. So this is one. It's a basic one. You know basic stock valuation, but you do not know constant growth, non-constant growth, zero growth. So remember, there is a conditions to apply this method, another condition to apply this method, and third condition to apply this method, right? Besides this basic stocks, right? This is the one of the basic method that you have studied. So besides this one basic method, we have other three methods: constant growth to find the value of the stocks, non-constant growth again to find the value, and fourth one is a zero growth. And these three methods have a different conditions, different requirements. You cannot choose whatever methods you like, constant, non-constant growth. It depends upon the growth of the stocks or the dividend, especially dividends, because we are estimating the value of stocks using the dividend. So under constant, non-constant growth, so zero growth, we will see the dividend. Is it growing or not growing? If it's growing consistent, or growing is non-consistent, inconsistent, right? So this is the ideas for common stock valuation method, right? So let's take a break now. I'm giving you a break early because this topic is not so long. So we're gonna take a break now. And after break, we will continue with this basic stuff and constant, non-constant, and zero. So these four methods we will study one by one. Right. So before we go for break, anybody has any question? Okay, so let's start with the common stock valuation. As I explained you before, that in this common stock valuation, we're gonna estimate the present value of the stocks. So in order to estimate the present value of stocks, we have a different methods. So I repeat, under common stock valuation, we're gonna estimate the present value of stocks. right? We will find the present value of stocks. How can we find the present value of stocks? That you study in your topic 2, that you're gonna discount future value, all right? Future value of cash flows. So these cash flows could be a future price of stock or future dividend of stock. Now, what is the difference between the future price of stocks and future dividend of stocks? What's the difference? The difference is, if you wanna sell stocks, you don't wanna be a shareholder. You don't wanna be whole share. You wanna sell stocks to make profit. This is called the future price of the stocks. And future dividend of stocks means if you wanna hold the stocks. If you hold the stocks, means stockholder. If you hold, you receive dividend. If you sell, you receive the price that will help you to make profit, right? Because buying minus selling price is the profit or loss. So we assume it's profit. Now what we're going to do, we're gonna choose this option, future dividend of the stocks. So means if we will discount the future dividend of the stocks, that will give us the present value of the stocks. So we're going to discount the future dividend of the stocks. All right. So as I said, we have 4 methods. One is a basic. Second one is a constant growth. Third one is a non-constant growth, and fourth one is a zero growth. All right. So basic, you already studied in your topic 2, which means future dividend divided by 1 plus RT. So basic, you're discounting the future value of the growth of the stocks. But 3 different methods, these are you're gonna study in this session, in this lecture: constant growth, non-constant growth, and zero growth. So let's start with the constant growth. So first one is a constant growth. Okay, constant growth method. Now, what does it mean, constant growth method? So remember, constant growth method apply to those situations when your dividend is growing constant manner. So means every quarter your dividend increase by 10%, right? So constant growth method means we apply the method is a situation when dividend grow constantly, right? So remember, dividend. Why? Because as I said, we focus on a dividend way. We're not going to focus on the future value of the stock. So we are using dividend to estimate the present value. So we have three situations. Dividend has a constant growth, dividend has non-constant growth, and dividend has a zero growth. So these three methods belongs to this dividend situation. All right, so future dividend situation. So when dividend grow constantly means, for example, every quarter, whenever company announce dividend, it's grow constantly. It's grow by, for example, 10%. First quarter 10% grow, second quarter 10%, third quarter 10%, fourth quarter 10%. That's the meaning of constant growth. Right? I repeat, your dividend grow constant. So what we're gonna do, we're gonna calculate present value. How are we gonna calculate present value? So we have a formula. Formula is P0. P0 means price of stock now. Zero means now. Present value. So price means market price. We are calculating price of stock now. This is zero. Zero means now. Now, formula is P0 equals to D0. D0 means dividend now. 1 plus G divided by R minus G. All right. So G stands for growth rate. That's company find by itself by analyzing the future project where company gonna invest money. All right, company gonna analyze that how much growth will have in this project, how many percent our money will grow. In other words, you can say that how many percent shareholder future investment will grow. Right? So this is called growth rate. G stands for growth rate. And again, G stands for growth rate. And R stands for discount rate or rate of return or interest rate. All right, interest rate. So D0, 1 plus G, R minus G, right? Okay. Now, if you multiply by D1 plus G, for example, your dividend grow, your growth rate is 10% 1 year. So 10% 1 year means D0 1 plus G means D1. D0 1 plus G means D1, which means if you multiply by your present dividend with the growth rate, you have a future dividend. So D1 is a future dividend. Future dividend. And now you're gonna discount it by R minus G. You divided R minus G to discount future dividend. Why? Because discounted value of future dividend equals to present value of the stocks that we looked at in the previous slides. If you have a look, previous slides, you can see that discount future value of dividend or discount the future value of cash flows that we're going to get it in future. all right? If you discount it, you will estimate the present value of stocks. So present value of stocks, we can write it as a P0, right? So that's why discount value of future dividend equals to P0. So this the purpose to divide R minus G is discounted. Okay. Now, very important information. Keep in your mind that remember, never R less than G. Always R greater than G. All right. R always higher than, always is greater than G. If R less than G, what does it mean? If R less than G means your denominator, this is denominator, this is numerator, this is denominator. If R less than G, your denominator value will be in negative. As a result, your present value of stocks will be in negative. All right, that's basically, this is the wrong way to find it. So R less than G, all right? It's never possible. It's never happened, all right? Second, R equals to G. That's also never happened. Why? Because if R equals to Z, there is a zero growth, all right? There is zero growth because R equals to G. In other words, you can say that if R equals to G, your denominator value is also zero. So we won't be able to discount the future value. As a result, we won't be able to find a PV. So which means P0 equals to P1. So which means present value equals to future value. Is it possible? No, it's never happened because discounted future value is the present value, not present value equals to future value. All right. If present value equals to future value, it means there is no any growth. All right. So if there is no any growth, why we are applying constant growth model? All right. So that's why R never be smaller than G and R never be equals to Z. So always R greater than G, which is denominator. So D1 divided by R minus G, you got P0, which is the value of the stocks. All right. This is constant growth model. All right. So is it okay? Did you understand constant growth model? You get the ideas of constant growth? Any questions regarding constant growth? Any questions, constant growth? Okay, so let's have a look at the question. So I'm going to show you a question. That question may be not in your lecture slide. That's from your different slides that I didn't send you, but I'm going to show you this question. If you want, you can take a picture or you can note down. Anyway, I'm also recording this session, so you can download the session later to watch it if you don't want to take a picture. So I'm going to show you the question. So here, this is your constant growth. So D0, 1 plus G equals divided by R minus G. R is the rate of interest, right? So D1, so if you D0 multiply by 1 plus G will equals to D1 divided by R minus G to discount it to get the present value of the stock. So remember that I already explained you that what happened if G greater than R. So that's going to give you negative denominator. As a result, your P0 value is going to be negative. and G divided by R, G equals to R, denominator gonna be 0. As a result, P0 equals to the future value of the stocks, and which just doesn't make any sense too, right? So that's why is always R is greater than G. So let's have a look at the question. So this is the question. Suppose Big T just paid a dividend D0, which is 0.50 per share. It's expected to increase its dividend by 2%. If the market requires a return of 15% on assets of this risk, how much should be the stock for selling now? Selling for now. So what does it mean? What is the present value of the stocks? Can you tell me? Calculate and give me the answer. Try to give me exact number instead of approximately. Yes, that's right. 3.92, right? 3.92 is the correct number. So how we got 3.92? The formula is D0 1 plus G divided by R minus G. So D0 is 0.50 and growth is dividend expected to increase by 2%. So growth rate is 2% divided by R. If the market requires rate of return, RRR or interest rate or cost of capital or opportunity cost of capital or cost of debts, anything you can call it. So in simple words, interest rate is 15% on assets, on investment. So R is 15%. So if you solve this formula, you're gonna get it 3.9231. So which means the present value of the stock is 3.92. All right. Let's move on to the next question. So can you calculate the present value of the stocks? And student, remember one thing, every session, every lecture, I take your attendance by saving your name of the list, name of the students. If I found, because in the beginning of the class, we had like 39 students. Now we have just 30 students. So 9 students are disappear. Of course, they are not online. So I save the student list in the beginning of the class and at the end of the class, and I compare who absent, who didn't log in. So you're gonna lose your marks if you log out before we finish the class. All right, so make sure you do not log out. Otherwise, don't complain that why you lose low marks in your attendance. All right. So can you calculate and tell me how much is the value of stock for this question? $14. So how much? 14. Everybody got 14? Anybody got different answer? Not 14? If everybody got 14, you all are wrong. 14 is wrong. Make sure you read question again. 8.4, no. 16, no, it's also wrong. Anybody got different answer? Make sure you read question carefully one more time. What question is saying? It says that suppose 16, 9, no, wrong. Suppose More Oil is expected to pay $2 dividend. So this is dividend, D, in 1 year. 1 year. And you go back to the previous question. Just paid 0.50. So what does it mean? Just paid means D0 now. And $2 dividend in 1 year means D1. This $2 is D1. So what does it mean? You don't have to calculate D1. D1 is given. You just simply have to discount it. D1 divided by R minus G. All right, so make sure you read your question. Is it D1, D2, D3, or is D0? If it's D0, then you have to convert in D. If it's D1, and then you discount D1. Yes or no? So the right answer is 13.34 something. So 13.34. So D1 is $2. So D1 is $2 divided by R minus G. R is 20 and G is 5. So $2 divided by 15 and you will get 13.3. Right? So this is your constant growth model. All right? Now let's move on to the next method. Next method is a non-constant growth. All right, non-constant growth means you do not receive dividend. You do not receive dividend at the same rate. So for example, 1 quarter 5%, second quarter 5%, third quarter 10%, fourth quarter maybe 2%. This is called the non-constant growth. Your dividend do not grow with the same rate. It has a different rate, up or down, maybe up or down, but rates are not same. Could be 5%, 10%, 15%, 20%. Your growth is not consistent. Growth is not same. So this is called non-constant growth, right? So let's have a look at the question. Question is, suppose a firm is expected to increase dividend by 20% in 1 year. 1 year, first year, 20%. by 15% for 2 years. So what does it mean? First year 20%, second year 15%, third year also 15%. So 20, 15, 15. After that, dividend will increase at the rate of 5% per year indefinitely. So which means unlimitedly. So 20%, 15%, 15%, 5%, 5%, 5%, 5%, and so on at the rate of 5%. Right. So this is the question. So overall, your dividend is not growing in the same way, right? So this is your growth rate. Now, if the last dividend was $1, last dividend means what? This $1, what does it mean? What does it mean? $1? D0 or D1? D0. D0, because D1 start from 20%. D1 start from 20%. D1 20%, D2 15%, D3 15%, D4 5%, D5 5%, 5%, 5%, so on. So this $1 was a last dividend. So which means it's a D0. And the rate R is 20%. What is the price of the stocks? All right. Now, what we have to do here, we will calculate D1. So D0, which is 1, multiply by 1 plus 20%. So we got D1. Now, D1, whatever is the value of D1, multiply by 1 plus 15%, D2. All right. So whatever is the value of D2, 1 plus again 15% for third year, which is D3. All right. And D3 multiply by 1 plus 5 is D4. And we will stop at D4. Why? Because after D4, we apply constant growth model. Why? Because after D4, we have the same rate, same growth. Right? So once D3 is finished and D4 onwards, we have the same growth. So that's why we will not calculate, we will not keep calculating, because time period is unlimited. So we will calculate until D3. From D4 onwards, we apply the constant growth model, and we got the future dividend, and then we discount it to calculate the present value. All right. So let's have a look how does it work. So here is a question. So D0 is $1, right? So first year growth 20%, second year 15%, third year 15%, fourth year 5%, and after 4 year it's unlimited. All right. So we calculate D1. D1 is D0 multiplied by 1 plus G. So we got D1. So D1 is 1.20. D2 is D1 multiplied by 1 plus 15%. Second year growth, which is 1.38. So D2 is 1.38. D3, 1.38 multiplied by 15%. So third year is 15%. So 1.38 multiplied by 1 plus 15% is 1.59, right? And then after D3, we have a constant growth. So D3, 1 plus R divided by R minus G. So we got future value of the stocks. So which is future value of the stock is 11.13, but we do not need a future value of the stocks. We need a present value of the stocks. So we will You can either discount it or you discount it. All right. So if you discount all the D1, D2, D3, and P3, if you're going to discount all the future value, you will get the present value, which is 9.32, right? Which is the present value of the stocks using non-constant growth method. All right. So is it okay? So you understand, yes or no? Okay. All right, so that's all about non-constant growth model. Let's move on to the last method, which is last method is zero growth. Here, zero growth. So did you remember anything from so let me open a whiteboard first. So zero growth. So the fourth method is a zero growth. Did you remember anything about it's really relevant to the zero growth. Now, what does it mean, zero growth? Zero growth means your dividend do not grow. So we also call it constant dividend. Right? Constant dividend or zero growth. Constant dividend means same dividend. Zero growth means no growth, so that's why same dividend. All right. So now, dividend do not grow. What does it mean? So remember, keep in your mind that growth and time, they have an association. As time pass, the value of stocks change. We assume everything's are stable in a market. So we assume as time grow, the value of dividend also grow. All right. So if we do not have any time, we don't have any growth. Vice versa, if no growth, no time period. So there is no any future value, all right, because there is no any time. So the idea is that this zero growth model or method represent a perpetuity. Perpetuity. Perpetuity means unlimited, which means no time. Which means no time. All right. So idea is that if there is a zero growth in a dividend, then we can apply the same method of perpetuity, the same formula to estimate the present value of the stocks. And what is the perpetuity method to estimate the present value of stocks is PV equals to cash flows divided by R. All right, because again, no time. So only cash flows divided by R. So after doing whatever you will get it, that will be P0 under zero growth model. So I think we don't have to study this one because we already covered. We already covered in topic 2. Topic 2? No, topic 3, I guess. Yes, topic 3. Yes. We already covered in topic 3, perpetuity. All right. So this is the ideas for zero growth model. All right. So remember, method 1 and method 4. Method 1 is a basic basic valuation, and method 4 is a perpetuity. Perpetuity. These two methods we already covered in topic 3. All right. And in this lecture, which is topic 4, we focus on the constant and non-constant. These two methods, which give us the future value, then we're going to discount it to estimate the P0. All right. So that is the ideas for your common stock valuation method. So common stock valuation method is finished. So topic 4 is finished. So anybody has any questions regarding this topic 4? Any question? So no question. If no any question, then we stop here. All right. Then I'll see you again on this Saturday afternoon. All right, Saturday afternoon, 1 p.m. Right, so on Saturday afternoon, we will start a new topic, which is topic 5. And once we finish topic 5, then I think if no midterm exam, if university not open, then I will give you assignment. So anyway, assignment, if I'm going to give you assignment, so I will discuss this assignment information next week, same day, which is Thursday morning. So next week, Thursday morning, I will give the final decision. Again, waiting for university reply. So then I will make the final decision whether you're going to have assignments or midterm exam. All right. So if no questions, then we stop here. I'll see you on this Saturday afternoon, 1 p.m. All right. See you. Thank you. Bye-bye. You too.